Now, according to the third Consumer Credit Rehabilitation Index, the national rehabilitation prospects of South African consumers already in the default position improved marginally by 0.3%. This is in the fourth quarter of 2017 compared to the fourth quarter of 2016. But what do credit numbers say about the MPC decision today? David Hurwitz, who is the CEO of Transaction Capital, joins us not to discuss this further, that is. David, good to have you in the studio. I'm going through the numbers here, and I think my first question would be, what is the correlation between the ability to actually pay back much of this credit and inflation figures?
Yeah, so there are a whole bunch of things a whole bunch of effects that you need to put into play when you're working on a consumer's ability to repay debt. Obviously, one of the most important things would be the level of household debt to income, and we've seen that improving over the last few years nicely, deleveraging very, very slowly. Certainly what's important is levels of debt. If you take a look at the lenders in South Africa, the consumer lenders, the banks, specialist lenders and retailers, they've constrained their credit extension over the last while. They've been very nervous in the environment that we've seen. I think that will change going forward, but that's very important, the level of credit extension. And then, of course, costs, which are driven by things like inflation, which is also driven by the rand, dollar exchange rate, which we're seeing some nice stability, as well as other things going into inflation, most importantly, as you say, interest rates. So I think most of the points that I've listed there have all moved in a positive direction, and in our index we're actually seeing a positive result that the consumer has more ability to repay their debt, and specifically the over-indebted and consumer who is in what we call non-performing loan status.
I mean, this is very interesting that you say that consumers are getting into a better position financially and starting to rehabilitate their debt, as you say. But really, how is the things like the VAT increase that we're about to see, as well as the fuel levy, going to impact on that, as well as the trend that you've been seeing for the last 2 quarters?
Yeah, so first of all, the trend that we've seen over the last 2 quarters has been positive. So in 2017, quarter 2 to quarter 3 moved positively by about 0.4%, and quarter 3 to quarter 4 moved positively by 1%. So those are very marginal increases, but nonetheless increases, because running into this index over the last 2 years, we saw the index reducing. So clients would always say to me, my clients are the big banks, the retailers, people like that would say to me, what is the state of the consumer? I'd always give some type of anecdotal response, but this is an empirical response. We do a sample of 5 million consumers, and we score their ability to repay from quarter to quarter. So it is empirical. The question really was around, well, the negative effects, things like, I think you said,
the VAT
increase and the fuel levy. So on the fuel levy, again, the rand has countered that. Fuel prices have actually come down from December to where we are right now. That is a negative that will cost, but there are too many, well, I'd like to hope that there are too many positives, things like interest rates, if this happens today, things like inflation staying at the level where it is, that hopefully we'll see this type of recovery coming from the consumer.
And investor confidence, I would assume, has an impact in some or other way on the health of the consumer.
Yes, well, that's, I guess the final thing is, if you look at South Africa, there are 2 balance sheets that we have to try and access. One would be the international balance sheets, and certainly as CEO of Transaction Capital, whenever I'm engaging with our international shareholders, pre-December and post-December are different worlds. So there is a real confidence from the international markets when they look at South Africa. We need that to result in foreign direct investment. We need to also access the business balance sheet. And if those 2 balance sheets, international and business, invest into the country, and if that ultimately results in greater levels of employment, and we've seen a slight benefit, but it's still stubbornly high. If you can get greater levels of employment, that really is the trick to a recovery in South Africa.
David, I want to pick your brain on something here that's very baffling. If we're to go by statistics, Gauteng province alone does account for close to a seventh of sub-Saharan Africa's GDP. Now, that being factored in, its ability to pay back is way lower than Western Cape, which is at 6.6. What is the variable here that actually drives people to pay? Is there a thing as being rich, but you don't actually want to pay your credit?
There are lots of reasons that drive people to pay. We find most people want to pay. So access to having disposable income or having access to funds is the main impact. If you look at what's happened over the last few years, credit providers, the lenders and the retailers have not really provided consumers with access to capital. So often what a person needs to do is they do need to take some debt from somewhere to rehabilitate themselves. Credit needs to be used positively, and that hasn't been able to happen over the last while. But at the end of the day, if you have disposable income, we find that the people that we engage with are trying to rehabilitate themselves to get back into the credit cycle, because people all over the world, and specifically in emerging markets, need credit to improve their lives.
David, the news of the day, MPC, if we do get a cut, are people not likely to borrow more money because they might think that they've got a little bit of extra income every month? How would that work?
So I think, first of all, we all hope that this cut comes through today. 25 basis points is what, from what I read, is what expected, and maybe another 25 basis points later. But really what is driving right now the dynamic in the market of what is driving consumer lending is really the lenders as opposed to the consumers. So lenders have been, as I say, I'm repeating myself, they've been extremely cautious. I think that will change. There's far more confidence in the market, and as lenders are seeing an improvement in the consumer, I think we'll see a credit extension starting to open up. So it might not be driven by the rate cut, it might be driven by confidence that lenders see in their consumer environment.
David, finally, I think it would be interesting to note the correlation here between M3 money supply and actually people's ability or inability to pay. At least, is this covered in your research? Because whenever we see a more expansionary monetary policy stance being taken over by the SARB, this is vis-a-vis M3 and more money actually being pumped, more liquidity pumped into the economy, it might be reflected on people's propensity to pay. Do you actually cover this in the research?
So, there are many things covered in the research as to a person's ability to repay. It's driven by how much debt they have, but to a large extent that's a secondary factor, or the base of the research is that as more money comes into the economy, so there is more credit extension, and that does allow funds to move around, and hence consumers to repay. So the answer is yes.